What is happening? What is going on? I'm gonna pause this for a second. This is the live feed from the Fed. Jerome Powell joins us at the New York Economic Forum, and we're expecting something dovish, or at least we're praying for it. Just like last FOMC, it seems that their audio equipment is, I don't know, they got room in the world to infinitely print money, but not ever to secure audio equipment that works. It's baffling. If you're out there, Jerome, listening, which I know you are, feel free to shoot me a message. I can come help you guys. I'm no audio expert, but I can at least help you get a stream going. Hopefully this is audible. This is legit just their feed. I think that this does confirm our reptilian overlords, as that's clearly reptile speech. That's reptile speech, chat. Wow. What is happening? Let me see if I can refresh this, but I don't, it's not that. They have 13,000 people watching it. 13,000 people are listening to this. What in the hell is going on, dude? I heard the word 38, so we're on to something.
Service at the Fed.
Ooh, the Fed.
Was a visiting scholar at the Policy Center in Washington, D.C.
Washington, D.C.
And state
State
fiscal issues.
Fiscal issues, guys. That's the whole thing. Do you see? Again, this is their live feed. Do you see here this muted microphone button? This is like maybe on someone's laptop. Issues. In the end, New York City. All right, all right. I'm gonna pause it here again. I can only assume that this audio will get better by the time TomPow speaks, which should be shortly. It was I don't think they have him very back in the line. I think he's a headliner for this. This guy's clearly introducing, warming us up, but this audio is absolutely inaudible. I jumped on because I was like, ah, crap, Jerome's going to be speaking. Let's get a stream. He will be at the FOMC on the 1st of November, so he will be live then as well. We're gonna power through this. I'll try to translate if it doesn't get any better. He nodded. Maybe he knows now. No, a little half grin, head shake. No. What? Making sure my headphones aren't dead. What? I mean, way to come out with the least strong show of confidence here. It's just like, we can't even get our audio equipment to work. We can't even get a guy on stage that anyone can hear the words he's saying. But we really need you to trust and follow our monetary policy. I will give them the benefit of the doubt. Monetary policy has very little to do with streaming live audio equipment. And I guess after that guy said that, now they're like kind of good and they're going back to this screen. I might have to call TomPow up and see what the hell's going on over there in New York City, because that is quite something. This is still their live. See if maybe we can decipher some of his codes here. Maybe guys, if we speed it up like that Beatles song, Let's speed it up at 2 times and let's see if maybe it'll have some kind of message for us. $28.
Service at the Fed.
Service at the Fed.
At the policy center in Washington, D.C., on federal and state fiscal issues.
Camera switch. What the hell is actually happening? Like, what was that? That was the most embarrassing show we've had so far. I can only assume, because we don't know what they said, that yes, Chair Powell will be on. He is scheduled to be here. That was not Chair Powell. Though I will say it was about as helpful as some of the comments we've heard from him in the past. About as maybe decipherable. I don't know. Maybe he said all the secrets there that he's not allowed to say. I don't know. We'll find out. This is still going, and here we go. We're I guess the host has ended this meeting. Wow, this is hilarious. This might even be better content than Chair Powell being silly. Like, what is this? Did you like? The Google Zoom has ended. Or no, that precious background. Now back to the tunes, maybe. Well, they lost. We saw this earlier. They had 14,000 viewing. They lost 3,000 viewers, 4,000 viewers. I'm surprised they were able to hold on to almost 10,000. Despite that, there we go. Now we got some live fed tunes. Okay. Soothing, calming. You still throw that up in the background while we chill out here. They can't even keep the tunes going, can they? Embarrassing. Hey, pull up the chat. I'm entertained. I'm thoroughly entertained. There's 500 of us out there who are entertained. What's up, guys? Chair Powell will be joining us. As soon as they figure out the basics of streaming, it seems. And I did put a gracious offer out earlier that I would help them if they contacted me. I'm not the utmost expert in the world, but I think I could get it so their audio works. There's a kind of gamble there. I don't even read the messages. No, never. I was trying to figure out what's going on, guys. Now I'm reading the messages, giving you a little intro. CNBC people yelling. CNBC has a music performance. Open CNBC. All right. This is from the Fed, though. This is from the Federal Reserve. What? Oh, this is probably their own camera. All right. They got 20K watching here. This is probably a better one. Although, I mean, that was pretty entertaining. Like, those are secrets. That wasn't some kind of secret language. I think if you listened closely, you would have heard some things you weren't supposed to. Who's singing? I don't know. Listen to this chatter. Let's turn this chatter up. This could be real alpha. Listen for insider trading secrets. Listen closely. Did I hear buy Bitcoin? No, I didn't hear buy Bitcoin. Just made that up. What is this? Where is Chair Powell even out here? Where is he? Is that him? That could be him. What are they chanting? There's like people chanting for a little bit. Climate protesters? Are they really? What is happening? Felipe Tomas, I agree, dude. I threw this on last second because I was like, shit, I should cover it. I did not expect what we've had so far. Sounds like a darts match. Read chat, bro. Never. Do we have the data, Foxy? I can guarantee one thing today, and that's that we do not have the data. They're saying wash your dishes now? All right. More data. I missed the show. You missed all the show. What did he say?
Today, in addition to those in the room, it's really a privilege to welcome students from NYU's Stern School of Business, Columbia Business School,
and the
Rutgers
Tom
University,
Crown
and Mercer
community.
University,
You guys
all
are
of
the
whom are
best.
joining us virtually. And we also have the members of our largest class of 20.
Yeah, nobody cares.
Washington, D.C. of Bloomberg. David is the anchor for Bloomberg Wall Street Week.
Off fossil finance. Off fossil finance, Jay. Off fossil finance. Off fossil finance, Jay. Off fossil finance. All right. It's catchy. This is so much better with audio. No wonder he smirked.
Thank you very much. Thank you.
Wow, what? I will say, I don't know who this guy is. I probably don't like him, but I do like the way he handled that. What are they saying? Oh, fossil finance. Oh, fossil finance, Jay. Oh, fossil finance. Finance. This makes so much more sense now, guys. What's up, loading name? Fossil finance, Jay. Oh, fossil finance. Are you guys going to join in? I like how okay, so this makes a lot more sense. It almost seems that they knew this was going to happen via, like, the audio earlier. We couldn't even tell that this happened earlier. Something social profits. Protest. I bathe in oil financed by Jay. That's right. Welcome to the circus. That guy handled that with such rapport. Like, he was just like, he smiled and waited and was just like, thank you.
He just shouldn't be on the stage with them.
He just shouldn't be on the stage with him. Awful finance. I think that's right, Tillin. Awful finance, Jay. Awful finance. And so I guess that happened, and then what, they took a break to clear them out, probably to throw them in jail? Fossil finance. What is fossil finance? Is that Litecoin? Charno, you just slayed me for today, my friend. That's hilarious. I mean, we could playfully call Bitcoin fossil finance. I don't think it's accurate, but we could call it that. We could. That was something. I will say, all right, so they cleared the stage 5 minutes ago. Still waiting. Just still waiting. All right. All right. Maybe we could look at some charts. I don't know. I kind of really want to hear Chirpow after those protesters. We stopped the feed, so now it's like... anyway, very descript. Now they're clapping.
Thank you, everyone. The good news is I'm not going to repeat the introduction.
Thank God.
And we'll
Thank God.
start
Give him
off
a round
where
of applause.
I was. Jay
Oh,
is going
fossil
to speak
finance,
for
Jay.
a few
Oh,
minutes
fossil
and provide opening remarks. And then he's going to be followed by a conversation with Bloomberg's David Weston. David is the esteemed anchor of Bloomberg Wall Street Week. This conversation is on the record, and we do have media on the line and in the room.
Ooh.
Let's welcome Jay to the stage.
Jay, Chirpow. Jay's a terrible name. Chirpow's a good name. Bitcoin's rallying into Chirpow and Solana actually breaking the new yearly highs here, I believe.
Thank you to everyone for being here today. It's great to be back at the Economic
Solana
Club of New York,
$26.
where I last visited before COVID. So before our discussion, I'll take a few minutes to discuss recent economic data and the outlook for monetary policy. Incoming data over recent months show ongoing progress toward both of our dual mandate goals, maximum employment and stable prices. And I'll start with inflation. By the time we raised rates in March of 2022, it was clear that restoring price stability would require both the unwinding of pandemic-related distortions to supply and demand,
How's the
and
audio?
also restrictive monetary policy to cool strong demand and give supply time to catch up. These forces are now working together to bring inflation down. After peaking at 7.1% in June 2022, 12-month headline PCE inflation is estimated at 3.5% through September. Core PCE inflation, which omits the volatile food and energy components, provides a better indicator of where inflation is heading. And 12-month core PCE inflation peaked at 5.6% in February 2022 and is estimated at 3.7% through September. So clear progress there. Inflation readings turned lower over the summer, a very favorable development. The September inflation data continued that downward trend, but were somewhat less encouraging. And shorter-term measures of core inflation over the most recent 3 and 6 months are now running below 3%. But these shorter-term measures are often volatile, and in any case, inflation is still too high, and a few months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. We cannot yet know how long these lower readings will persist or where inflation will settle over coming quarters. While the path is likely to be bumpy and to take some time, my colleagues and I are united in our commitment to bring down inflation sustainably to 2%. In the labor market, strong job creation has met a welcome increase in the supply of workers, due both to higher participation and to a rebound of immigration to pre-pandemic levels. Many indicators suggest that while conditions remain tight, the labor market is gradually cooling. Job openings have moved down well below their highs and are now only modestly above pre-pandemic levels. Quits are back to pre-pandemic levels as well, and the same is true of the wage premium earned by those who change jobs. Surveys of workers and employers show a return to pre-pandemic levels of tightness, and indicators of wage growth show a gradual decline toward levels that would be consistent with 2% inflation over time. To date, declining inflation has not come at the cost of meaningfully higher unemployment, a highly welcome development, but also a historically unusual one. Healing of supply chains, in conjunction with the rebalancing of demand and supply in the labor market, has allowed disinflation without substantially weaker economic activity. Indeed, economic growth has consistently surprised to the upside this year, as most recently seen in the strong retail sales data released earlier this week. Forecasters generally expect GDP to come in very strong for the third quarter before cooling off in the fourth quarter and next year. Still, the record suggests that a sustainable return to our 2% inflation goal is likely to require a period of below-trend growth and some further softening in labor market conditions. Geopolitical tensions are highly elevated and pose important risks to global economic activity. Of course, our institutional role at the Fed is to monitor these developments for their economic implications, which remain highly uncertain. But I will also say, speaking for myself personally, I found the attack on Israel horrifying, as is the prospect for more loss of innocent lives.
F-war.
Turning to monetary policy, the FOMC has tightened policy substantially over the past 18 months, increasing the federal funds rate by 525 basis points at a historically fast pace and decreasing our securities holdings by roughly $1 trillion. The stance of policy is restrictive, meaning that tight policy is putting downward pressure on economic activity and inflation. Given the fast pace of the tightening, there may still be meaningful tightening in the pipeline. My colleagues and I are committed to achieving a stance of policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we're confident that inflation is on a path to that objective. We are attentive to recent data showing the resilience of economic growth and demand for labor. Additional evidence of persistently above trend growth, or that tightness in the labor market is no longer easing, could put further progress on inflation at risk and could warrant further tightening of policy. Along with many other factors, actual and expected changes in the stance of monetary policy affect broader financial conditions, which in turn affect economic activity, employment, and inflation. Financial conditions have tightened significantly in recent months, and longer-term bond yields have been an important driving factor in this tightening. We remain attentive to these developments because persistent changes in financial conditions can have implications for the path of monetary policy. My colleagues and I remain resolute in our commitment to returning inflation to 2% over time. A range of uncertainties, both old ones and new ones, complicate our task of balancing the risk of tightening monetary policy too much against the risk of tightening too little. Doing too little could allow above-target inflation to become entrenched and ultimately require monetary policy to wring more persistent inflation from the economy at a high cost to employment. Doing too much could also do unnecessary harm to the economy. Given the uncertainties and risks, and given how far we've come, the committee is proceeding carefully.
Okay.
We will make decisions about the extent of additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks.
The protesters
Thank
stole
you.
the data.
I look forward to our
Get them.
conversation, David.
Get those protesters. Yeah, that was pretty much nothing. Maybe the questions will have something because we've found that these journalists are getting kind of more and more impatient with the same song and dance every speech. So something I've noted or noticed again is Powell's drive to say something like, if we do too little, this is what will happen. And if we do too much, this is what will happen. But then never saying, not making anything, no cognitive argument with it. Just like, we can't do too little or too much. Like, that is nothing. You're not saying anything. Like, we can't overdo it or we can't underdo it. All right, well then, what are we doing? Here we go. Sitting down with another old guy.
For being with us today, for the remarks, and
he said Chair
for
Powell.
having a bit of a
Smash likes for Chair
conversation.
Powell.
Really appreciate it. It strikes me it's a particularly propitious time, given everything that's going on in the world and in the economy. There's a lot to talk about, a lot to discuss. Let me start with something you just referred to, which is the surprise to the upside in the economic data, despite, as you termed it, I think, historically fast pace of growth. Are you surprised at how resilient the United States economy is? Just today we got jobless claims numbers, surprised because they were low. We got the retail sales numbers you mentioned. We got industrial production. Across the board, it seems like a very strong economy, despite all you've done to try to slow it down.
Yes, so we certainly have a very resilient economy on our hands. We've got the economy growing strongly. If you think back a year, many forecasts called for the U.S. economy to be in recession this year. Not only has that not happened, growth is now running for this year above its longer run trend. So that's been a surprise, driven largely by consumer spending, driven by a very strong job market with people getting jobs with first high nominal wages, and then as inflation has come down, real wages, which is spurring spending. And we've also had inflation coming down. So, it really is a story of much stronger demand. There may be some ways in which the economy is less affected by interest rates. It's hard to know precisely, but for example, many companies, any company with bond market access will have termed out its debt, right? And therefore may not be feeling the effects of higher rates. The same may be true of homeowners who have a long-term fixed rate, low rate mortgage, who then are therefore not, because it's not an adjustable rate or a higher rate, they're not feeling that increase in rates. So the economy may be somewhat less susceptible to the effects of rate increases. On the other hand, if you look at interest-sensitive spending, these are very much the places where we expect to see and do see effects. So, for example, in housing or the housing sector has been very affected by higher rates as purchases of durable goods. If you look at surveys, people will not say that it's a good time to buy a car or a house, quite the contrary. So we see policy working through its usual channels. It may just be that rates haven't been high enough for long enough, and again, it's all happening in a context of very strong demand.
We've heard other people speculate maybe the terming out of debt, as you say, both corporate debt and household debt, may diminish the effectiveness of rate hikes. Do you have a view on whether that's true? And if it is true, what does it say about monetary policy? Does it mean you have to go farther in the rate hikes, or do you just not have the power to affect it?
So no, I don't think that there's a fundamental shift in the way that interest rates affect the economy. There may be some differences in this cycle because of what I mentioned. as I mentioned, we are seeing the effects where we expect to see them, which is interest-sensitive spending and also asset prices to some extent, and the exchange rate, which you're also seeing a strong exchange rate, which is disinflationary. So I don't think there's a fundamental change in the way monetary policy affects the economy. And again, it goes back to just very strong demand. We take the economy as it is. We take fiscal policy and the economy and all the things we don't control. They come to us, and we conduct policy always to achieve maximum employment and stable prices. So we just take what comes. The fact that we have a strong growing economy, a strong growing labor market, and inflation coming down, these are the elements that we want to see that to achieve the outcome we want. It may take more time, but ultimately, this is the kind of thing you would want to see along the path to getting through this without a big increase in unemployment.
How much effect thus far has the Fed had? We all have memorized now long and variable lags. How long and how variable, and where are you in that process? Are you at the 25% point, the 50%, in terms of seeing it in the effect in the real economy?
So there's no precision in in our understanding of how long lags are. One thing that has changed in the modern era is that markets now, over the course of the last 30 years, central banks have decided, instead of being secretive, to be very transparent. And what that has meant is that markets move actually well in anticipation, well before our policy moves. So the transmission from policy moves to financial conditions actually happens before the moves now, whereas that was not the case 50 years ago when Milton Friedman coined the phrase long and variable lags. So, but now you have financial conditions changing, and the question is, how does it affect the economy? The standard channels are asset prices, interest-sensitive spending, and the exchange rate, for example. And we do see that happening, just not as fast as we would like. And I would attribute some of that to just stronger demand. Household savings were turned out to be higher. Household spending has been stronger, and that's by far the largest part of the economy.
In order to conduct monetary policy effectively, do you need at least a hypothesis about how much has already hit the economy?
You need a
hypothesis.
hypothesis.
It's hard to know how much more you need to do if you don't
You
know
don't have
how
a
far
hypothesis.
So on lags, I think if you think back,
Ruble breaking out against the dollar, sign of dollar weakness.
it's been a year since the last 75 basis point hike we did. It was at the November meeting in 2022. The first one was in June, so it's more than a year. So we should be seeing the effects. By the way, they don't all just arrive on one day.
My bad, I'm not awake yet. That is definitely roll Bitcoin.
They arrive and then they're thought to peak and then to diminish. So there's a lot of uncertainty around lags. And one of the reasons why we have slowed down significantly this year is to give monetary policy time to work. The truth is, though, you can find academic support for different speeds and duration of lag. So we have to use our eyes and a little bit of risk management and patience in slowing down the pace to make sure that we are seeing the full effects. And I think, again, that's part of why we've slowed down this year. We went very quickly in 2022 to catch up to where we needed to be, and now we're moving carefully with these decisions.
So when you spoke back in August of 2020 and sort of laid out the revisions to the framework, as it were, you said that in terms of anticipated growth, the sort of consensus had gone from something like 2.5 to 1.8%, I think were the numbers you laid out in that.
Thank you, Joseph, Thijus, Wei Mong, Lure Potion, Rocky Moon. Guys, thanks for subscribing. Keep subscribing. Smash those likes. Share the stream. I love you all.
Where are you now? Where's the Fed? Where are you?
Where
and what you
are
think
you
basically the
now?
long-run growth is?
Do you know where you are right now, Chairpow? Do you know where we are?
Long-run potential growth is not something that moves around a lot over time, but I would my own guess is it's around 2%. I think that the standard mainstream view would be a little bit below 2%, but I would just say 2% real growth over time. And what causes growth is growth in hours worked plus growth in productivity. Growth in hours worked is a function of population growth in the long run, and also labor force participation. Many things affect productivity, but if you drop in reasonable, standard, longer-term estimates of hours worked growth and productivity, which is just output per hour, productivity growth, you get something around 2%, and that's higher than most other advanced economies.
As you look at it, do you see historical precedents for having a growing economy with high rates over a long period of time? I mean, as you look back, I mean, is it like the late 90s, for example? What analogies do you draw as you try to determine what this might be doing to the economy over the longer term?
So that's really a question about what the level of rates will be going forward, what the neutral level will be, and I think it's very hard to know confidently what the answer to that will be in 5 years. Some of the reasons why rates were low for the last 25 years were just the aging of the global population and globalization, and so lots of savings and relatively with an aging population, savings greater than investment, so rates are lower, and productivity was low. So all of those led to low interest rates. So what has changed with the pandemic? You might see less effects from globalization. Certainly demographics, the aging of the global population has not changed. I mean, this is a discussion we're having on an ongoing basis. It doesn't really affect current policy, but where will rates settle out? What will be a normal rate? So if a typical Fed tightening cycle.
If you don't know, who knows? You need to know. This is your job, Powell. Sure, Powell.
Would leave you at 5 or 6%, and this is in the before the pandemic and before the low inflation period, you would have had Fed rates in 4 or 5% or even higher frequently. Are we going back to that? I really don't know. I wouldn't want to speculate.
What do you know?
My guess is it'll be somewhere in the middle, but I
do you know where you are?
I think we can say this now.
Right now. What can you
the
say?
effective lower bound is not an issue. We were very concerned about that. Right now, we're very far from the effective lower bound, and the economy's handling it just fine. But that's because we're at a time of really elevated demand coming out of the pandemic as we reopened with fiscal stimulus and monetary stimulus. We have very strong demand in the United States. Hard to know what the economy will want in the way of interest rates when 5 years from now, when all of the effects of the pandemic are behind us.
You mentioned the long-term equilibrium range, which you talked about again back in Jackson Hole in August of 2020. Back then you said you thought the sort of consensus had come down. I think it was from like 4.25% to 2.5%. Where is it today?
So I think by any reckoning, long-term interest rates and the neutral interest rate came down steadily over the course of several decades. So where is it today? I don't know. We're finding it, basically. The idea was, I think the median indication of what the real neutral rate was around 50 basis points before the pandemic. It may have risen in the near term. The real question that matters, though, is will it rise in the long term? And that we don't know.
But do you need to know it in order to conduct monetary policy? I mean, you must have to have at least a theory. I mean, I'm not saying you have to be right about it, but you have to have a hypothesis, don't you? As you look at the data, you have to put the data through some sort of theory.
Yeah.
So we all write down our estimates of the longer run neutral rate every quarter in the summary of economic projections. And that's based on models. It's based on also looking out the window and including lags, thinking how are our current rates affecting the economy. So the evidence of your eyes is that the economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough. You're right, though, but we have models for everything. We have formulas for everything. Ultimately, as a practitioner, we have to be focused on what the economy is telling us, even taking lags into account. What's it telling us? Does it feel like policy is too tight right now? I would have to say no. I think the evidence is not that the policy is too tight right now. And we're at 5.25% to 5.5%.
Do you think we're entering into a new phase in monetary policy? We had the Volcker disinflation, I think you referred to it as. And then we had sort of inflation targeting for a time. There was concern about secular stagnation. We were pushing the zero bound, as you said. We were concerned about that. And then we had the pandemic, and we had the real problem with inflation. What's the next phase look like? How would you describe it?
What we've been through is, in all of the advanced economies around the world, was a period where the effective lower bound, the proximity of interest rates, risk-free interest rates to the effective lower bound, which is zero or a little bit less, was a big problem for monetary policy. And just rates came down and down and down. And the problem is, if rates are going to be close to zero in good times, then how do you cut? And so have central banks lost the power of their most important tool, which is interest rates? This was a subject of a vast literature in monetary policy research for 20 years. And the most common answer was some kind of a make-up strategy. So you would credibly promise to run inflation a little bit hot and above 2%, and that would anchor inflation at 2% to counter the times when it was below. So that was a very serious problem, which filled books worth of research. Then comes the pandemic, then comes the response to the pandemic, and then comes the pandemic inflation, not just in the United States, but everywhere. The question is that a secular change, or are these factors that brought us to that place, are they still out there waiting to come back? And, books are written on this subject now. You can argue that, and some have argued that effectively the last 20 years before the pandemic were kind of a perfect storm of disinflation. And now that's all gone, and we're going into a more inflationary period that will be characterized by more supply shocks and things like that, and therefore more inflationary pressure. Yeah. So are we going into such I don't know. I mean, all I can tell you, I think it's unknowable, and, great theorists and researchers have different views on this. It's not something you can settle in advance. We'll have to see.
Mm-hmm.
I think our issue is right now trying to achieve a sufficiently restrictive stance of policy to bring inflation down to 2% over time. That's what we're really focused on.
Whenever any of us go, particularly institutions, go through tumultuous times, and goodness knows you've been through a tumultuous time, we look back and think, okay, what did we learn? Sort of an after-action report. Look at the pandemic and the pandemic inflation. What would you say you learned in terms of macroeconomics, in terms of the economy, from that experience?
Nothing.
So hindsight is always a wonderful thing, right? I think the fair way to judge the actions that were taken is to put yourself in the place of legislators and policy, other and central bankers around the world. And there was no playbook. We hadn't seen a global economic shutdown. People were thinking that the pandemic might kill a whole lot of people, and that we wouldn't have a vaccine for 5 years. We might not have an economy for 5 years. So these things were all very possible in March of 2020. And so we pulled out all the stops, and Congress pulled out all the stops. With the benefit of hindsight, could we have done a little bit less and had a little bit of inflation? I guess we could. But I think if you look overall at the performance of the U.S. economy, our economy is the strongest. We're actually also making the most progress on inflation, but we certainly have the strongest growth. We're back to prior growth trend, not just level of where we were. We're actually back to the prior trend. The labor market, the last time we had this many consecutive months of unemployment below 4% was in the late 1960s. So it's more than 50 years ago. So our economy is doing very well from all of that. But if you had perfect hindsight, you might not have had as much inflation if we'd done less. Although other countries who didn't do as much as we did also had substantial inflation problems.
I think my question was just a little bit different. It's not so much of assigning blame or saying, did somebody make a mistake, as
I'd like to blame
are
you,
there
though.
things that going forward would change the way you conduct monetary policy that you learned from that maybe nobody had reason to know at the time, but it was an experience you went through?
Well, we were in a time of a very long time, in a reasonably long time, of disinflationary forces. And I think everybody's instinct had been attuned to risks coming from this direction, which is too low inflation. And so what this has taught us is that now that period is over, and we now have probably going forward a more balanced set of risks where high inflation and low inflation are both risks. In fact, right now the risk is still high inflation, but I'm assuming once we get back to 2%, we won't have that. But we've certainly learned that, and events are.
Yes, it's life.
The possible range of events is so much wider than what we think it is on any given day, right? The tails are so wide, and it's just not human
still
nature
climbing.
to constantly be thinking about things that are way out in the tail, but they happen in financial markets and in economies. They happen far more regularly than they should.
I suspect every person in this room is well aware of what's going on with yields with bonds. It's been a big story, particularly in the longer end of the curve. What is your understanding of what is going on in the bond market and why those yields are going up, particularly, again, at the longer end of the curve?
So it's really two questions. One is why is it happening, and the other is why does it matter for policy? And so I would say on the why is it happening question, I think it's appropriate to have a little bit of humility. It's always hard to say exactly what's going on with longer term yields, but this is what I think we can say.
Okay,
First,
you can say something.
What it's not. It's not apparently about expectations of higher inflation. And it's also not mainly about shorter-term policy moves, so Fed funds moves over the next year or two. Really, if you can look at the 2-year, for example, and 2 years moved up a little bit since September, but really the move is in longer-run bonds. So it's really happening in term premiums, which is the compensation for holding longer-run securities, and not principally a function of the market looking at near-term fund rate. I think a few other ideas about. There are many candidate ideas, and many people feeling their priors have been confirmed by this event, I'll say, as well. But so one would be just that markets and analysts are seeing the resilience of the economy to high interest rates, and they're revising their view about the overall strength of the economy and thinking even longer term this may require higher rates. That could be part of it. There may be a heightened focus on fiscal deficits. That could be part of it. QT could be part of it. Another one you hear very often is the changing correlation between bonds and equities. if we are going forward into a world of more supply shocks rather than demand shocks, that could make bonds a less attractive hedge to equities, and therefore you need to be paid more to own bonds, and therefore the term premium goes up. So all of those are possible ideas. Then the question is, does it matter for us as long as I'm talking about this? So the way I think about it is, we change our policy. Actual and expected changes in our policy affect financial conditions, and persistent changes in financial conditions affect economic activity, hiring, and inflation. So one question is, are we seeing the longer run bonds, the increases in rates, are we seeing those come through in financial conditions in a persistent way? And I think if you look at financial conditions indexes, the answer so far would be yes, you are. Persistence, it will be a matter of just seeing with our own eyes, but certainly they're coming. If you look at financial conditions indexes, they're showing tightening, and it's a lot because of longer rates. Then the question is it endogenous? And is it just
endogenous?
Because the market expects us to take things, to take further actions to tighten monetary policy, in which case if you have to follow through. But that doesn't seem to be the case. It doesn't seem to be principally about expectations of us doing more. It seems that the other factors are the more prominent ones.
Another question is,
bottom line though, that means it probably does over time. It makes sense. It's something that we'll be looking at.
Well, that's the question I was asking, is over time. From what you understand right now, do you think this is a temporary phenomenon, or do you think there are structural factors, whatever they are, and we can talk about what they might be?
I like the way this guy's hitting the questions.
This is the future we're looking at now.
Well, so of the factors I just listed, some of them are shorter term, some of them are longer term, and some of them could be either. So, for example, concerns over fiscal deficits, that could be a longer term factor. The change in correlations between stocks and bonds could be a longer term. I don't think we know. I think, basically bond prices are set by supply and demand. The supply of treasuries is a known thing, but demand can be affected by any and all of these theories, and also just by sentiment too, which is hard to characterize. So, markets have been volatile. They've been longer. You've seen the rates moving up and down a lot. I think we have to let this play out and watch it. But for now, it's clearly a tightening in financial conditions, and so we'll be watching it carefully.
Talking about the fiscal side, and you've been very careful repeatedly to say you want to stay in your lane. You're not responsible for fiscal issues. At the same time, you have to take into account. And it looks like the United States is going to have to borrow a fair amount of money. By the way, other countries are as well around the world. We have a big supply of treasuries coming on board. To what extent do you think that is a longer-term issue? And let me tie it back to something you referred to in your remarks, actually. When we see geopolitical conflict around the world, like in Israel, like in Ukraine, some of the buildup with respect to China, the defense spending is going to be elevated for the United States and for other countries. Do you take that into account in figuring monetary policy? Because it may well mean that we're borrowing a lot more money than we have in the past.
So we, of course, see the same things that everyone else does. I just came back from IMF meetings this weekend, and there's a lot of talk of the very large resource demands that organizations like the IMF and of course, countries are facing, and the need for substantial amounts of revenue. You mentioned military. There's also dealing with climate change and things like that. So there's a lot of that. We don't, as you mentioned, we don't comment on fiscal policy.
Anything. We don't comment on anything.
Fiscal authorities have oversight over us, and not the other way around. So we stay away from that. So I would just say everyone knows that it's not a secret, and about all I can say is we know that we're on an unsustainable path fiscally. It's not that the level of the debt is unsustainable. It's not. It's that the path we're on is unsustainable, and we'll have to get off that path sooner rather than later. It's not really something, though, that affects a monetary policy decision about how much we raise rates in the next 6 months. It's not going to be driven by. If there were some vast new fiscal policy that were about to be enacted, and then that would have an effect on the models, and would have an effect on projections, and indirectly that would affect us. But we would not be in a position of responding directly to fiscal policy.
When we talk about the treasury market, obviously there's buying and selling, and the United States government is issuing a lot of treasuries. There's also a question of who's buying, and we now have one buyer who's stepped out of the marketplace, namely the Fed, which is a big buyer. At the same time, we're getting reports that maybe some of the overseas buyers may be pulling back as well. How do you take that into account in assessing where we're going with long-term bond yields?
So actually, I think buying by overseas entities has actually been pretty robust this year. So there have been some small changes, but I think by and large they've been buying robustly. Again, we look at the broad financial conditions. We look at interest rates, other asset prices. That's what we look at. We don't focus on fiscal policy. We wouldn't change monetary policy because of, for example, because we think that the U.S. is on an unsustainable path. Everyone knows that. We're just going to do monetary policy to achieve maximum employment and stable prices. And that's how we think about it.
I'm curious, though, one of the things you're most concerned about is the real economy, what's going on in the real economy. You distinguish yourself from some of your predecessors in that you have a significant exposure to the private sector, not just the public sector, academics. As you talk to CEOs, people in business, what are you hearing about the cost of capital? Because these bond prices are really affecting cost of capital for the first time in a while. There was a long time the cost of capital felt like it was almost zero. And business changes an awful lot when the price of money goes up.
I talked to several people this week who run companies, and they each said that the economy remains strong and that they don't see the consumer. You see, there's some areas where spending is softening, but overall, I mean, look at the retail sales number. The consumer is strong. Volume's not going up very much, but companies are profitable. You don't, now if you get to where I think the cost of capital would really matter would be for smaller companies and early stage companies, and that really does matter. So we don't have a lot of tools. We have interest rates, and they're far from perfect. It's famously a blunt tool, but it's what we have to get inflation down, and really the world counts on us to deliver low and stable inflation. That's what we have to do. And at a time like this, we know that we're having negative effects on. We had the home builders in this week. It's a very tough time in the whole home building industry, and we know that. But ultimately, what we want to get back to is a long period of price stability. That's the best thing we can provide, and that policymakers and businesses and everyone and people can just lead their lives not worrying about inflation. This is what we can deliver. It's what we have to deliver.
That'd be cool.
And this is the time. Our independence is not for times when
you can
we're really
start
popular.
This any moment, Chairman Powell.
Now, when we're doing
start
something
that at any time.
That really the public counts on us to do, notwithstanding that it's challenging and difficult, and higher interest rates are difficult for everybody.
You have not wavered
Doesn't
from your commitment
seem
to 2%.
so
You
hard
did it
for
again
you.
today, 2%. No question about it. There are those who suggested, including some colleagues in the Fed, that maybe the bond market is doing part of your job for you. Is that the way you see it?
Look, I would say it this way. The whole idea of tightening policy is to affect financial conditions. And to the extent higher bond rates reflect that they do, they're producing tighter financial conditions right now. So that's how monetary policy works. That's literally how it works.
Oh,
so
thank you.
Again, in principle, as long as bond rates are going up for some reasons, and they're not going up just because they expect us to do things, so that if we don't do them, they'll come right back down. And we don't think that's the case. Actually, I don't think it's the case. It doesn't seem to me that's where analysis leads you. Then sure, that's a tightening. That's exactly what we're trying to achieve.
And therefore, it seems like almost arithmetic. It must reduce some of the impetus for you to continue to raise rates.
At the margin, it could. I mean, I think that remains to be seen. And by the way, I'm not blessing any particular level of longer-term rates, but just in principle, that's right.
So let's talk about the labor market. You referred to that in your remarks as well. And as you say, vacancies have come down some, although they still are pretty elevated, if I'm not mistaken. Quits have actually gone up some. It seems to be a tight labor market. What do you make of what's going on in the labor market right now?
The labor market has been extraordinarily strong. So what happened in the pandemic was we had a negative labor supply shock, is one way to think about it. So a whole lot of people left the labor market when the pandemic happened and then didn't come back. And so when the economy reopened and everybody, there was revenge travel and revenge everything, very strong demand, and there just weren't the people. So you had 2 job openings for every person actively seeking employment. We've never been anywhere near close to that. There was panic, and wages and bonuses, and particularly in things like in-person services where people had not gotten big wage increases and didn't want to come back to work. So that's where we were. So since then, there are very many signs that the labor market is getting back into balance, and I talked about some of that in my remarks. Surveys of work, we survey businesses. We don't do it, but other people survey businesses and say, "Are
We do,
workers
we
plentiful?"
don't.
And that measure was no, but now it's back to pre-pandemic levels. You
Realized
survey
profits
workers,
on all
are
my
jobs
positions.
plentiful? And that was at an all-time high, and now it's still high, but back. So wage increases are coming back down to more normal levels. Job openings are down from 2 to 1.4.
Keep subscribing,
They were at
please. Hit those
1.2
likes and subscribes.
in the very tight labor market
Make
of
it juicy.
2019. By the work week, by so many measures, the labor market is gradually cooling. And part of that is this, all through 2022, we thought we were going to get more labor supply, and we didn't. And I personally thought, well, I guess we won't get any. And then we've gotten a substantial amount this year. The female labor force participation is in prime age workers is at an all-time high, which has to be related in some way to work from home. But labor force participation increased, immigration increased, and now you see that in the overall cooling of the labor market. So even though job creation is still very high, there are the workers to fill those jobs. And again, businesses will tell you that it's very different. It's still a very tight labor market, but it's loosening.
Coming back to your goal of 2% inflation, what have you learned from this experience about the relationship between inflation and labor? I mean, there's a lot of talk about a Phillips curve, whether it still applies, whether it's weaker, what is it? What's your hypothesis right now with the relationship between inflation and labor market?
Well, let me tell you what it was before. So one of my favorite charts is just the slope of the Phillips curve over 40 years. And so it shows the relationship between unemployment and inflation. If you go back to the high inflation of the 70s, there was a very tight relationship. And that relationship went down and down and down to the effect where the Phillips curve, there was almost no relationship, meaning the Phillips curve was very, very flat.
Subscribe like this.
Now, actually, if you just ignore cause and just look at the data, it will tell you that the relationship is back. Do we really think that's a sustainable thing? I don't know. What happened, though, was that people came to seriously expect 2% inflation, something like 2% inflation. And if people expect that, if companies expect it and workers expect it and you expect that in your shopping, then that's what will happen in a way. And that's what happened. So even in very, very tight labor markets, we didn't have high inflation. I was at the Fed since 2012 as unemployment went from 6 to 5 to 4 into the 3s for the first time.
Keep those subscribings coming,
the
hell
models
yeah.
were all saying that we should be seeing some inflation, and we never really saw 2% inflation on a sustained basis during that era. So we learned that the Phillips curve was really flat. Some pronounced it dead. Now,
crypto
I don't
face.
think most of the inflation we're seeing at all is from the Phillips curve, though. I think it was really the collision of very strong demand, really strong demand, with constrained supply. Cars being a great example. Many people wanted cars, didn't want to ride public transportation, wanted to move to the suburbs. Unlimited demand for cars. Interest rates are low. Yet we couldn't get semiconductors, so there are no more cars. Car production went down. How do you solve that problem? Prices just go way, way up for cars. That's how you clear the market. So that's a classic example of what happened here. It really wasn't about the Phillips curve. It was more about constrained supply and demand more broadly, especially for goods at the beginning.
Let's turn to another responsibility of yours, which is the banking system. Last March, we had something of a scare because of, I guess, interest rate risk with Silicon Valley Bank and then some others. Are we through
Banks
that
are resilient
now,
and
or are we
robust.
in that process? Are you resting easy?
So what you pay us for is not to rest easy. We don't do that. But I would say where we are is this, though. Things have certainly settled down. We see the funding markets is fine. We see, and we paid a lot of attention to banks that looked anything like the banks that had the problems, and made sure that they had credible liquidity plans and plenty of liquidity and all of that. And so I think all of that has worked. And we set up this facility that's available for banks to borrow. And so all of that has led to a real settling down. But, our job is to be on the case, and, we're still on the case. And we'll keep after that. Banks are generally very well capitalized and highly liquid in our country. Banks are strong. We benefit from all those years of reform under Dodd-Frank and Basel III that we went through, with former Governor Tarullo and many others.
Screw
And so
that
we
guy
benefit
wearing
from a very strong,
sunglasses.
well-capitalized banking system that's much better at managing its risks than the one that entered the global financial crisis.
Very well capitalized, but you want some more. This is
You're
a
talking about
proposal.
the Basel III proposal, which is, it's a rule that's out for comment, so there's not a lot I can say, but we do expect a lot of comment, and we do expect to take those comments very seriously.
Talk about commercial real estate. There are some concerns out there in the marketplace of what's going on, because obviously there's a repricing that comes with your increased rates. It's thought that there's some real estate out there that is not worth the money that was originally financed with it. How concerned should we be about that as something lurking out there that could really affect the system overall, not just the people invested?
So there's work from home, and that's affecting downtown.
Actually, I'm not
real
wearing
estate in
any
a lot of
pink,
big
so I don't know what you're
cities,
talking
about. Higher rates as well, as you point out. So this is an issue that we pay a great deal of very careful attention to. Commercial real estate is not a principal risk or a major risk for the very largest banks. Right. It is much more for regional and really the smaller banks have proportionally a much larger exposure to real estate, so commercial real estate. So what we've done is the supervisors are in there looking at real estate portfolios. They're working with banks to make sure that they have plans to deal with the problems they have in their portfolio. These problems evolve over time. They don't land with great suddenness like a market event. And so we're working with all of the bank regulators are working with banks that have concentrations of troubled real estate to work it out. There will be losses for sure. You can drive down through most downtowns, in many downtowns anyway, and see buildings that are empty and things like that. But we're working through it, and we're on that case, and don't see it as as presenting much broader problems. But our job is to make sure that it doesn't.
As you mentioned, regional banks are where a lot of people focus on this. As you conceptualize the banking system, what is the role of the regional banks? We have the super big banks that don't look like they're going anywhere. And we've got the community banks, the smaller banks that we understand are critical, particularly for small businesses and local context. But what about the regional banks? How much pressure is on them? And what would the damage be to the system if, in fact, there was more consolidation with some of the big banks?
I think the regional banks are very important, extremely important. We have 4,500 banks, which is a lot more than any other country per capita or per dollar.
We have the
GDP,
most banks.
We have, our GSIBs, the largest banks, are the leading banks in the world in profitability and in their success in their business. We have community banks who deal in smaller communities.
I tell you, we got the most
But we
banks.
also have these great regionals, and I think they do a great business with many companies, and I do think their business model is under pressure, and I would not like to see us add to that by treating them exactly like GSIBs. I think they don't need exactly the same attention that a GSIB gets. So, but I would say I personally think, and I think we at the Fed strongly think that the regionals and the smaller regionals are an enormously important part of our banking system.
Okay, you've been very generous with your time. Really appreciate it. I have one last question.
Really generous.
Are you having a good time? And
You
and
mean
if so,
now-
why?
Now or
No. I assume this wasn't that pleasant, but in general, you're enjoying your job.
I would say this. First of all, it's an incredible honor to do this job, and every day I do it, I feel so fortunate and so lucky and blessed to be entrusted with this. And all I want to do is do the best job I can for the public that we all serve. And yes, there's a lot that's enjoyable about it, but mostly it's just so important to get it right, and that's what we're trying to do.
Thank you so much, Chair Powell. It's really good.
Stop fossil finance, Jay. Stop fossil finance. That was the best part of all of this. We need 19 more likes so we can get 420, guys. This is clutch. We can do it right now. We have 400. We have 1,400 viewers. Can we just really quick? I barely even asked for likes this stream. You guys did an awesome job subscribing. I see so many new subscribers. I love to see it. Make sure new people join the Discord. Bitcoin Beast, Beer Kier, Give, Mr. Mojo, Cricket, Joseph Gunter, Thegis Verbunt, Wei Meng Chong, The Exodus, lotion, potion, pheromones, and more. You can join that list right now by clicking that subscribe button. I have my screens all kind of goofy. Let me move this over here. Not a lot of movement during that. Do thank Mr. Chair Powell for joining us, and he will join us again November 1st for the FOMC meeting, and I expect everyone to be there. It's mandatory. Kind of typical Chair Powell talk today, telling us about what happens if they do too little, what happens if they do too much, and then not telling us what they need to do or what needs to be done to split the difference. Very Chair Powell. A lot of nothing answers to be expected. I will say Chair Powell, they said at the end, he's like, "Are you having a good time?" And he was like, "Well, maybe not right now. This is tough." But he did kind of seem to be having a good time. I did notice that they called him Jay. Have you guys ever heard of that? Anyone call him Jay? Before this speech, I don't think they've ever referenced him as Jay, because he is Chair Powell. Maybe Chair Powell is getting so large and strong as an idea in our minds that they are now aware of it and trying to combat it. We didn't see Gina, which is a tragedy 1,000 times over. We'll definitely see her November 1st for the FOMC. But price action pretty actually similar. We didn't chart it out like we usually do, but very similar to what we've seen in the past in the FOMC meetings. Basically, markets trending one way. We can kind of see this on the dollar. Trending one way, down in this example. Chair Powell starts speaking. It reverses, goes back to about where it started, and then basically as he continues speaking, it continues in the same direction. So very Chair Powell market movements. You could probably see him in his pocket, market ordering shorts and stuff. Revenge trading, perhaps. Bitcoin long or short. I'm in both. I'm schlong. Schlong is the laziest answer, man. But I'm schlong. I am the schlongs. My long is still open. I still have the ancient long, the flex long, on Femex. Sign up for Femex using my link. They're our sponsor. They're dope. From 16.5, that's still open. That'll be open. The ape long we took about a week ago is now up only 6%. I don't know how I'm feeling about that. Entered at about $1. Now it's at $1.05. Kind of lackluster growth there. Not the explosive dead cat kind of a long sweeping rally that I had hoped to get off of $1. And now it's heading on back down. That does not look strong. I don't know if I want to settle that back up. I kind of do. Kind of want to just close it. That's not looking great. That was a fun trade, though. It was nice to just be like $1. We're just going to take it at $1. Gala eating shit. Gala in the garbaggio. Does it have hope? Everything has hope. But right now it looks very bad. Breaking past December, last year's lows. Now breaking again into intra-year lows. Down near 1 cent. I'm going to absolutely be looking at Gala if it hits 1 cent. Similar to the ape trade at $1. You can see that was the listing price here on Qcoin. Not that Qcoin's really anything special, but we got the short there at 1.5 cents, and we're targeting just under a penny, and that's looking honestly pretty likely. If it does hit a penny, likely I will look to snipe along just to be that guy. Stop loss is going to be pretty arbitrary, just kind of set to accordance with our upside target, which is not going to be very high, unfortunately. Maybe from that 0.09 back to 1.3, something like that. So I'm just going to change the stop loss to get my preferred risk to reward. So 0.0085 with an upside target of 1.322. That's I'd probably take that trade. We'll see. Ethereum looking lackluster here. I did tweet about Ethereum looking to bounce. I want to really quickly go over that. Ethereum versus Bitcoin. First Bitcoin here. So this is FBTC. This is not ETH dollars. So it can go up or down in dollars while still being in this pattern. So the reason behind it, I didn't put any explanation. Good reason to follow me on Twitter and to join the Discord for more info on stuff that I tweet that's more vague. Basically, very easy TA, not a lot of complexity here. Ethereum has been doing the same thing basically since last year, mid last year. It has, I will say, accelerated its downside movement on the weekly against Bitcoin, and now just hitting that 200 weekly moving average. You know, I love the 200 weekly moving average on every chart. Hitting it right now. So does that guarantee a bounce? Absolutely not. However, However, wow, there's too much on this chart. However, it is not a bad spot, especially, this is just a nice little kind of overall TA gem drop for you here because you made it through the episode. When we see something like this, or at least when I see something like this, remember guys, I'm not right all the time. I just do my best and share my analysis with you. Please don't take it as financial advice or copy my trades. Do you learn? But when I see something like this is in a falling pattern, I do look for it to break to the upside, but typically what I look for to be the trigger for that move to eventually move to the upside is going to be an increase of that momentum or acceleration to one side. So we can see very coiled, downward sloping price action that kind of all of a sudden dips to a new low, hits a previous support level, so it's like 0.62, and then accelerates. The acceleration is usually when I look, at least for a midterm or a interim bounce. I'm not saying Ethereum going to a new all-time high against Bitcoin here. I'm saying let's see 0.6, maybe likely on the table. Currently trading at 0.55. That is a solid like 10% gain against Bitcoin. That's pretty good. We do see looking left into June, fair value gaps, order blocks, whatever you want to call it over here, hitting that low. Now, I do think it is eventually going to go lower than June 22. However, I think before then, we return to, if you just use your imagination here, this descending trend line. I want to unhide, but it's too busy on the weekly. This descending trend line, if it can break through, set a higher high, Ethereum might then go back, let's see, kind of into the 0.75 area. However, in the likely scenario that it rejects, look for a retest of that 200 and more downside action. It's in a pickle. It's in a pickle. I don't think I've seen much in crypto that looks like this. Remind you that this is over a 900-day period. This accumulation distribution, whatever you want to call it. 900-day period. I think it's good for a bounce. I wouldn't get too excited on that bounce. What it does in dollars, anyone's guess, honestly. This is looking still like a broadening wedge down here. I don't know where this line's from. There we go. Still looking like a broadening wedge. We're down at the bottom. We did get another test of the low, like we were talking about back here, mid-October, early October. Looking for a retest of the high-end dollar. So if we think of it this way, the Ethereum Bitcoin pair, if that bounces, and we're looking for just a retest of this resistance to the top of this broadening wedge, that could mean that Bitcoin just trades sideways and Ethereum gains against Bitcoin, or it could mean that Bitcoin does move up, and that's going to bring me full circle to my next idea. And Ethereum moving to its resistance, that'd be about 1770. I kind of doodled this up while we were live, and I actually very much like it. I very much like it. It's not perfect. It's not perfect, but it's pretty damn good. I will really quickly point out to you the ways that people can make things look a lot better than they really are to try to like trick you for engagement, or I don't know, to try to make you invest. I'm not trying to make anybody invest or trick anybody, though I do bait the engagement sometimes. Here's the kind of things, the issues right here. Technically, we would expect this after the AR and before the ST phase B, but we have a higher high here. We do have LPS. We do have these higher lows. So that is in the picture. We do have a spring up into this SOS that is above previous resistance. So we do have all the pieces here for a Wyckoff accumulation schematic. We have our little PS up here right around our AR. That lines up. We have a low. That low is broken. We hit lower highs and higher lows on the way back up to that resistance. Lots of doodles. You can see how my charts get busy here. On the way up, past resistance. And now what we want to see is potentially a flagging or just a move to the upside. Just a move to the upside would be phenomenal. Absolutely phenomenal. What was I going to look at here? There was something else. Yes, really quickly, super quickly. Here we are. The location of this SOS potentially is what gets me interested. So get rid of all of that. Right here, 200 weekly moving average. This has been the boss. This has been the gatekeeper of Bitcoin, of crypto, all year. We traded below it in the beginning of the year before rallying, retaking it, and then recently, in August, losing it again, rejecting once, rejecting twice, 3 times, this time blasting through. If you're in the Discord, I did say, guys, it looks like it wants to test the 200 one more time. If it does this time, I believe it's going to break through. It has. It has. Now we just need to hold it, really. Ideally, I'd like to see it stay above, let's say, 28K, roughly where that 200 is. That's not a big brain comment. Let me see. 200 daily, right below it, flattening out. That 200 weekly still jiving. I will remind you, Bitcoin has never seen its 200 daily and 200 weekly this close together, or in reality, really ever together. This is the first time ever in Bitcoin's history that these two moving averages have been close together. It's quite an interesting setup, especially if you dig deeper into that rabbit hole. You'll find that there's a lot going on at 28K. This is the unquestioned most important price on the chart. What I do like on the weekly here is we have held the 50 week. We talked about this a lot. Holding the 50 week is our bare minimum, like upside trending rally line, and that line is now moving to 25K. And it does look like it's going to continue holding. We do have 3 days and 7 hours left in this week, and we definitely want to see a close above the 200 weekly. I do not want to see this sell back off, even though the price difference would be only about 2% to be below the 200 week. I do not want to see that candle paint. I do not want a long top wick with a green candle that closes just underneath the moving average. I've seen rejection from that too many times. On the bullish note, if we do hold it, this 50 is going to continue trending up. And you guys remember all the way back here in like June, May, whatever, I was saying Bitcoin's going to see its first golden cross ever on the week. It just saw its first death cross in February, but this will be the first golden cross on the week. And the timing of that does look pretty consistent. It doesn't look like it's really moved, really like it's changed too much. This is a very slow moving cross. If we don't get an explosive move to the upside, if we get it, say my prediction of 48K, which is now all but memes, if we move up to 48K into the end of this year, that 50 is going to accelerate, and we're going to see that golden cross much earlier. If we continue to trade sideways for the rest of the year, which is absolutely possible, that cross is going to take forever. It's going to be like well into 24, and it's going to be hella boring and slow. But right now, things are not looking too bad. I'm pretty good on it. Let's hide this stuff. Let's look at our Ichimoku cloud we have in a little bit. I'll read the chat. Sorry, fam. I can't do too many things at once, or I'm not able to give them my full attention. On the day, above the cloud, I like that. The cloud has twisted here in October. At the end of October, interesting. Actually, here's some alpha. The Ichimoku cloud on the day is twisting on November 1st. That is the day of the FOMC meeting. Spicy. However, that does present a weakness in the cloud, which could suggest a sell-off, but we'll have to see some other factors line up there. This does signify a change in winds, and we can see the bearish change in wind started in September 5th, right before we hit that low. What I do like here, and maybe this is actionable or tradable for me, is the TKKJ on the day are very close together. And they're obviously, I didn't even need to look, right at 28,000. I think if we do get a swing at 28.3s-ish, there is a trade to be made with a stop just below 28K. Basically betting on those two, I don't know to call them lines, Ichimoku cloud lines. They're not moving averages, but they're kind of like moving averages. Real quick take, basically what they do is they look back. The green one, obviously only looking back a shorter amount of candles, the purple looking farther back, and taking the highest point in price and the lowest point in price and putting a line right in the middle, and that's what generates them. That's the simplest take on that. But I do like that they seemingly are holding support here. I want to check out the week. Interesting big cloud here on the week. Maybe suggesting that 23.8 is in the future, but the future meaning looks like in 24. That could be the low of 24. I could see that happening if we don't get a rally to 48K this year. 28.3, high June on the week, and we're just peeking out of the cloud. This is definitely a sketchy place to be, as we have seen in the past, kind of these little fake out peaks above the cloud before being rejected. This would also suggest that, similar to what we were looking at on the day, that 28.3 is the number for this week to close, and closing it would be rather juicy. I like it. Weekly looking strong on Market Cipher B for the first time ever, maybe. I mean, that's how it feels. Momentum on MACD waning off over the last 8 weeks. 8 weeks, looking for a peak into positive momentum, and I'll pray for that. I'll pray for that. That'd be good. Let's see. All right, let's put it down to the hour. Let's put it down to the hour, really low time frames quick. I might be able to hypothesize a trade for us. I like these low time frames. They're looking pretty good. I like these low time frames. So I think long is my play today. A little more weakness on the hour. Ooh, actually, I really like what I'm seeing. Here's my conflict at the moment. My conflict is this. I like what I'm seeing on low time frames. I make a new chart. I like what I'm seeing on low time frames, so that looks like I would probably go long if I was forced to make a trade today, which of course I'm not. But I'd like to put up a theoretical one just so there's something in the next stream for people to call me out on or say, hey, that really worked out well. Long really looks like the play, but I don't like this. I don't like this like high sell-off. You do have a higher low. That's cool. Yeah, maybe we are going up here. 29.1 was my original on the pump day, on the fake ETF day. When it fell, I said I'm still looking for 29.1 today. Didn't quite get to 29.1 that day. Got to 28.8, but 29.1 would be roughly where that is decent ascending trend would be. Oh yeah, I gotta bring it down here. 29.1 is the 618, so all right. But I don't like longing into this, but I think that this is going to be it for me today. Remember, not financial advice. I'm not always right. This is just for you guys to see how someone else might approach trades or charts. The only thing I don't like is I feel like it gets faded here. Yeah, maybe we catch it, but maybe it doesn't actually make it all the way up there. Maybe it doesn't. Not the most confident in this one. I'm not the least confident either. Let's see. Yeah. Is there anything I'm missing? Anything I'm missing? Then you throw the fib on it and it looks kind of topped out. I think a better entry would be 28.5 than right here. I think this is a much better entry. No, there we go. 28.5, then what? You already have a 3 point something to 1. That's not bad. All the way down here is 1.5. 2.8. This is probably the smarter trade out of these, but for the indecisive or impatient traders, I think there's still this play here. Just targeting 29.1, maybe 29, just to be less greedy. Here we go. Something like that. That's cool. All right, let me see if anyone's even still here, guys. I do want to thank you again for joining. That was dope. It was absolutely funny. Absolutely funny. Hola, Crown. What's up, French Toaster? Let's see who's here. We still have a bunch of people here. I love it. Desamad, Andre Faria, B. Frank Crypto, Bruno Nascimento, 420 Bud Monster, Colin Stoltz, Crypto Tatted Zach. How you doing, Crypto Tatted Zach? Daniel Montenegro, Digital Asset DJ, my bro, French Toaster, Gene, Greg Cranston, Jacob the Jeweler, Johan V. Who else is here? Andruska, Kick Drum, Liquidated Shorts, John Foster Crypto, loading name, of course, Matthew Barnes. How you doing, brother? Good to see you. Magnus Larson, our favorite comment wizard, Midnight Madness, Mike Bennett, Mr. Kaiser, Nikolay Dimitrov, Overrated Jake. Bro, don't ever say that about yourself. You're not overrated. If anything, you're underrated. People should rate you more. Randy Greer, Rodney Coden, Smiu, I can't say that one. Stoby, Tazio, how you doing, Tazio? What are you feeling today? Pickle, Tillin, Tomin, Mouse, Watoshi, Worston, Baruj, and Monkey, Sin, of course. Love to see it. Foxy, I saw y'all stream. Good to see you, brah. Always here. Hell yeah, guys. If you're out there and you haven't subscribed and smashed the like button, you haven't joined the Discord, you haven't signed up with Femex, our sponsor, do all those things today. Join our fam. The Discord has hundreds of live traders talking all the time, constantly. I can't possibly oversee it all myself all the time. It's wild. You definitely want to be in there. I just saying Hitler. All right, interesting. You should stream every day, Randy. Well, we did. We were doing that. And then the market got chiller, and I don't like when price hasn't moved at all, and I streamed yesterday and I go on again and it's like, all right guys, nothing's happened. Nothing's moved. I don't have any new thoughts. And so we did this Monday, Wednesday, Friday thing. Once the spice comes back, we'll be live again 5 days a week. I forgot to say this really quick. Sol is blasting. Looks like it did hit some resistance here. That makes sense looking to the left and even to the local price action, but it did hit a new Q4 high, not a new yearly high, testing 25.77 earlier this morning, and that lines up, well, pretty much with what we've been looking for on Sol forever. We've been playing it each step up. Yes, this long right here technically did get stopped out a little bit, but the rest of them pretty good. Looking for a break of that 24.80. We got it. This candle could look prettier. It could, but actually, I don't know if this bad boy's done yet. It is hard to bet up on something that just moved up like that. But looking at the hour, look at this juice. Look at that juicer. That money flow right at zero. Momentum a little threatening. 4 hours saying, nah, dude, just be in my arms. It's okay. You don't have anything to worry about. 12 hour looking good too. All right, I got to look for an entry. I mean, the obvious entry here, 24.79 or 24.80. This is definitely a high risk trade. This is basically chasing back up. I'm not going to take this one, but I could see this trade being done. I don't think you should look for too much upside, honestly, though, if you're going to be going long, like at the high of the pump. I wouldn't look for too much upside. So let's see if we can kind of figure out a little something, maybe something along these lines. The patient trader, of course, likely waiting a little lower. 23.88 wouldn't be terrible. Actually, 24.14 looks pretty good. I kind of want to do it this way now. I might do it this way. How much upside do I need to be able to hit that low? Too much. There we go. 3-1 there. That's tradable. I'm still probably not going to take it, but congrats to Sol. Everybody who's been a Sol Bowl. Guys are doing good. I did show you this, but I wasn't able to comment while Chairman was live. Moons. So here you go. Great lesson in don't copy or listen to influencers. Just take any value they have, apply it to your own stuff, make your own decisions. If they don't have any value, don't watch them. Moon. So cryptocurrency Moons. I love the subreddit r/cryptocurrency. It is the largest cryptocurrency community in the world. It's got like 6 million subscribers, and they had a native token on the Reddit platform. They had their own blockchain, and it was doing really good. It got listed on MEXC. It blew up, and so here's the story. I bought some of this, obviously not up here. I bought it down here at like 5 cents. However, I'm still pretty cooked on this position, as right here, 2 days ago, Reddit pulled the integration from the platform. And this is an example, learning lesson here. Look at this. Minus 90%. And this wasn't even over 24 hours. This was like in 10 minutes. Rugged. Reddit basically rugged the platform. Dumped like crazy. I do think that this is still going to see about 10 cents in retracement. I do. About 10 cents in retracement. Just look at where it fell from. Slap on that fib, and you see 10 cents. Nice psychological level. This would be not a terrible move to see sell back off. I don't know the future of this, but this is like how fickle things are. To me, this was a great risk to reward play. Especially back here, the market cap was only like 20 million. And we have coins with $1 billion market cap that no one uses and are gibberish. This at least has the biggest community ever behind it. And it just got rugged by the platform it was on. Learning lesson. The lesson being, never put all your eggs in one basket, no matter how good of a bet it seems to be. Eggs are not meant to be in the same basket, period. You can end up this way. I maybe have $300 of it or something with an average of like 5 cents, so I probably still have about $300 of it. But I certainly am not going to be looking to buy more. I'm not looking to go in anymore. Reddit pretty much rugged that coin for this subreddit. RIP. ADA continues to drop in a similar descending fashion to Ethereum. If this high actually had not gone to a new high here, it would look almost exactly the same. ADA against Bitcoin did lose support and now does seem to be in a bit of a free fall. A bit of a free fall. We do see on the monthly here, strong potential support levels. They're a little bit lower, though. A little bit lower. I could see a bounce potentially at 632 sats. That's 25 cents down, or 25% down. And maybe, depending, you might be revisiting these fresh December 1920 lows for a pretty ugly 44% drop. Obviously, that's all on the table. ADA USD looks like death, and we've been saying that for a long time. I'm not selling my ADA or anything like that. If we do see ADA fall in dollar value, I'm going to be looking for about 12 cents. I may end up adding to my bag at 12 cents if it gets there. I'll let you guys know in real time. I'll let you know. All right, trade filled. Injective. Can't believe Moons and Safe Moon weren't legit projects. So best never lost. That's a good point. Yeah, things with Safe, Rocket, Inu, Elon, Moon typically are awful, right? They're typically awful. This is different. This is why I was willing to at least take a little gamble, because they didn't mean moons like moon. It was like actually, maybe I should just show some of you because you might not have ever seen it. Here you go. This what used to be integrated into their thing. You can see here like posters. It shows how many moons you have. They have 6.9 million members. Market cap was 20 million. Nobody promised moons on this. And yes, I do understand that most of the time when things are called moon, that's what they're suggesting. This one wasn't. This one wasn't. But it still did not play well. S&P 500, by the way. That short's still looking good. It is just at the short entry here. We said, yeah, maybe 4,400 at the highest to fill this gap. Didn't quite fill the gap. I'm still pretty confident on this short here, but it may take some time to play out. Let's pan to the dollar if I can. Onto the day. Ooh. Ew. All right, a little bit of weakness on the dollar. I'll take that. After 12 weeks of ripping, finally a little weakness. Momentum on our top side band here on the week. Does look like it's pinching. VWAP is hitting 0. Money flow moving down with it. That's pretty good combination of signals for me that the dollar's looking to retrace. But the problem here, the problem with that is you've moved up so high. Yeah, how far is the retracement? I would like it to be all the way back down, obviously. But that's not probably reality. Our 618 is sitting at 102.3. Our shallow retraces are the weekly resistances previous to this rally. So where does it go? I do not know. But I would expect to see one of these. I mean, if more than one hits, yeah, I'm going to get the logic of that. But I would expect to see one of these. I hope it actually goes farther down. But this weekly close actually looking pretty awful. Bearish engulf here right after a bullish engulf candle. That is a sign to me of a rejected rally or maybe exhaustion on the buyers. Maybe not a crazy thought. After 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 weeks of green, one exhaustion kind of top wick spinning top candle, bullish engulf. Buyers might be a little tired here. They might be a little tired. I will say there's also an argument that you could say this is actually a little Wyckoff looking if you see the dollar flag up here above 105.26. You have a spring. It's not quite as clean as the chart or as the one I showed you guys back here. It's not quite as clean, but it's an interesting thought. Interesting thought. There we go. Yeah, right. Yeah, right. Okay, here it is. Those aren't it either. I got too many charts, guys. Too many charts. I always have too many charts. Here's the trades I just threw up. Cool. Let me get back to the chat. Really quick. Okay. Perfect. HRT, ADA equal LMAO. True, true. Pulse chain equal king. Hey, to each their own. You're glad Tom's streaming. Nothing like a nice nap with TA in the background. Hell yeah, best never lost. If I can provide a good night's sleep to just one of you, my mission is a success. Thank you. Too many puppies, never too many puppies. That's fake news. Ben trade. Yeah, we look at Ben. I haven't looked at Ben in a while. For you, Matthew Barnes, anything, my guy. DeWedgie Facts. What's up, Zegon? What's up, guys? AJ. Who else? DeWeege. Danielle. Oh, I got that one. Eric. Francisco. Hassan. Kai. What are you doing, Kai? Kai is here. Everybody give a round of applause to Kai. My beautiful future wife. And then even more future ex-wife. It'll be a great ride, though. Don't worry, Kai. It'll be a lot of fun. It'll be a lot of fun. What did she say? Did she say something? There it is. She said, yep, milk and gold. Yeah, we look at gold, too. Bencoin not looking terrible, honestly. Not looking terrible. Not looking the worst. Let me pull up gold, too. Not looking the worst. This could look much, much worse. So I will say something. I will say this. There was stuff, I don't know who dumped, back here with the divorce, the coup, whatever you want to call it, of Ben. There was dumping from wallets. And I don't know if it was Ben or Hit Network or whatever. And then there were also accusations perhaps of other large holders that were not supposed to be able to dump yet, like a vesting schedule dumping ahead. So I'm not endorsing this as an investment, but what I am saying is if we saw those major kind of origin wallets capitulate, and someone will have to do a little homework digging into this to see if that's true and what's left, there is potential upside here. There is. Mostly because all of that selling pressure, all of those coins that maybe, I don't know how much they paid, but are then sold at the lowest traded price, they basically clear the order book. There's very little demand to get out. Those coins being bought up down here will look to take profit, and that's when we typically use our Fibonacci extension tool. This gives us a good idea of when people might look to take profit. And we would say maybe right here or right here. You can see today's rally just hitting that 1618 extension, our 2 measured move up here at however many zeros, 769, nice, about 40% move to the upside. Not guaranteeing this is going to happen, obviously, but when you have capitulation like that, you do see reduced selling pressure, obviously, because those coins have changed hands at a different value, and now there's different people holding them. Interesting. I would not go long with your money here, personally. I would not even with your grandma's money, although your grandma's money is precious and I would never risk it. If I was for some reason really into buying this, which I don't know why you would be, but hey, to each their own. We've seen a lot of weird coins being yelled out here. I'd probably look down here in this 0s to 7 area. That's a 44% dump from here. This would be a decent place to look for a long. You have weekly resistance here that was broken through with gusto. And to see maybe this happen would not be out of the realm of normalcy. Let's see. Beautiful. And if it does go up to the 7 or to the measured move target up here, if it does, then your 618 retracement is right there at that support. I kind of like that. Kind of like the way that looks. Add alert. Add alert. Do I have alerts? Good. I'm going to move this alert up to that entry 2.6. Let's do 2.7. There we go. We'll see. I'll take a peek at gold. Ooh, Kai with the alpha here. On the weakness of the dollar today, gold is taking a little stretching of its legs. A little leg stretch here. All right, that actually looks pretty darn good. Let's go. On the month, gold bullish engulfing September's loss here, trading at 1971. Do have some monthly resistance just under 2K. That's also going to be psychological resistance. So likely to see some profit taking there. Maybe a move back down. Gold, moves very slow, so we could see it do something like this as well, where it hits a low, comes up, kind of messes around with this high, continues to set lower highs, and eventually looks to retest that all-time high set May of this year. It's hard to believe gold hit an all-time high in May of this year. It's weird. This chart's looking not bad. It was looking pretty bad as it fell last month. This bullish engulf would be a great close for it. We have 1, 2, 3 weekly tests of this high. I believe on the next test, it actually will break it. I think it will actually break that high. Not like in May, like actually break and maybe do some kind of measured move target. Let's see. 2400 looking pretty juicy. 2400 looking pretty juicy. Right around here. That is the extension from our high to our low. That's our 1618. And then locally into our higher low potentially here. That's our measured move. I like that they line up. I imagine the dollar will have to see some pain in order for that to happen. I imagine. Welcome back, Cashew. Where's Cashew? Bitcoin's the new gold. Bitcoin is just... I feel like that's a bad comparison because Bitcoin's just so much better. That to compare them is unfair. Litecoin wants to drop, probably does. What's up, False Flags? How you doing, bro? Can I get a chirpow? Can I get a chirpow? Or a J? A J. What was it? End the fossil. Man, now it's out of my head. It was stuck in my head. But that was a good stream. That was wild. That was real weird. I'll look at Litecoin, but begrudgingly. Litecoin, my baby. My baby, you had such a beautiful setup here and you just shit the bed on it. Here's an example. Broadening, descending wedge, whatever. Broadening wedge. Not breaking out. Not following the probability. So remember, probabilities are very valuable in trading, but if we'll say this pattern is, I'm making this up, 75% probability that it plays out correctly, right? Meaning breaking to the upside off of a higher low, whatever. There's still 25%, meaning 1 out of 4 times that pattern won't work. Just based on randomness, based on probability. It did not work here. Yikes. Not looking good. Litecoin did hit an all-time low versus Bitcoin last year, depending on how you measure it. Depending if you count crazy wicks from a long time ago or not. But looking over here on the monthly, it could be looking for support, filling in the monthly fair value gap. And I will say that that is likely true if it can close its monthly above 00215. If that monthly candle settles up higher than June 22's close, I think that that is looking for a retracement, looking for the bouncing, and that bouncing probably 003. Maybe a little higher. Maybe. Litecoin. Look at this. People are like, why don't you look at Litecoin more? Why don't you talk about Litecoin? I like Litecoin. I still have my Litecoin. But it's not the easiest thing to make content about when for the last 6 years it's against Bitcoin just been in this channel. Not the easiest content to make. I still have mine, still holding on faith. I'm not going to sell mine. I'm not going to paper hands. And that's actually where maybe some of my confidence is I don't believe that Litecoin has paper hands. I don't think that the people that own it have paper hands. I think they're all like me. They're people who have been in crypto a long time. They've seen this rodeo. I don't think that they're going to go, oh no, it's going lower. I think that people that own Litecoin are likely to buy more Litecoin if it reaches whatever value they're looking for. I don't think they're going to sell for a loss now after 6 years, right? I don't think so. It's kind of a blessing that people didn't really get into it in the last bull run, because I think that would have put more downside pressure on it. Let's see here quick. Looks like those longs are filling. The impatient long may be going to get stopped out here. Maybe, baby. There we go. Looking weird. Looking weird, man. Looking very weird. This would look more normal maybe if we had a lower low here. Maybe down to 27.6. I don't want to see it, but it'd look more normal. Uniswap sold their soul. Wow, that is frightening. 26% of us with 600 votes are paying over $1,000 a month for their student loans now. Those just resumed this month. If you're not in the know, they've probably been trying to contact you. That's awful. That's $12K. No, it's more than $12K. It's probably more like $20K pre-tax just to pay that. That's insanity. Who's got hairy legs? You got hairy legs. Walmart partnership fake news drove Litecoin over. Yeah, probably. Do a Tor protocol. It's up over $1. When FOMC? FOMC is November 1st. FOMC, November 1st. Be here or be... Yeah. Yeah. There we go. No offense to our non-straight people out there. That's why I spelled it different. Let me see. CoinGecko really quick. Anything moving? What time is it? It's 1:42. I got a doctor's appointment at 3. So we got a little bit of time. Nice. We got a new subscriber. You love to see it. Who is it? Who it be? Dharma, Swanditha, and Billy Huey. Leo F. the Gov. Nice name. Riza Seaton, The Prophet. Powell Kolbus. Luke Leonard. Crypto Max. Bitcoin Beast. Beer Kier. Vidar Renissen. Nice. We got a lot of subscribers today. Gotta enjoy that. That's why I want to go live. Crypto Paw Coin is up 300% today. 1,000% in 7 days with no volume. We won't be looking at that. Bitcoin SV up 6%. Rollcoin up 6%. Sol Injective up 4%. We can look at that quick. All right, there. Second long filled. First long stopped. Patience always pays, baby. I'm gonna look at INJ quick. I'm sure someone asked for it. INJ just doing INJ things. Not so exciting. Just following the long, looking for 1280. Looking pretty good. Looking pretty good on that week. Looking very good on the day. All right. Yep, that's lock and load, baby. INJ looks good. That looks juicy. I would look for something like this instead of market ordering in now. I would probably look for something where you see a test of $9.75, some kind of pullback, maybe $8. Obviously, looking to hold $6.40, and then kind of that final test bounce break. That's looking pretty good. INJ. I don't think I own any. Got an alert for Theta. I did close my Theta long, and am I about to regret it? We're going to find out. Nay. I do not regret it. I do not regret it. Theta breaking lower. I'm glad I closed that long. I was really just looking for a bounce play there. Off of whatever news it had. Theta, I guess, looking for 35 cents. Time will tell. That does not look good. That looks terrible. Alt's looking pretty ass right now. What's up, Randy? YouTube Rayan. Waxp. We'll see whatever Waxipa is. Can you see your setup on XRP? Yeah, dude. Ooh, Waxipa long. Money. I haven't looked at this. Let's see. 41% take on that. That was live streamed God knows how long ago. Don't love that wick. But what I do love is I've been seeing this on more charts. You do have a higher high. Now, you could argue that, well, you have a higher high, but maybe you're just looking at this now. And that's possible. It's going to come down to where this really settles up, where it retraces, how much it can hold on these gains. For now, I'm going to leave it like this. I do like this. We have seen this kind of pattern, and I've noticed it, guys. This is something that I probably can offer you that really no other channel is going to or can. I have noticed over the last week some tingling of my senses here. What I'm seeing is these kind of breakouts on alts out of their patterns to the upside. Loom being another example. You can see I was not confident in Loom going higher. Loom breaking its highs, retracing. Keep your eyes peeled for these. Because typically, or at least in my observation in crypto, once you start see these happening, and we are seeing them happen, it tends to kind of reverberate through the space. So you'll see something else pump and then dump. So my advice, not financial advice, but my advice would be look for coins that have good setups, target resistance, take your trade, set your take profit to the upside, and get out. Get in and out. Because these pumps are getting sold off. Now, we haven't seen if they're going to go lower than their lows, but they are looking rather spicy. Like spicy. They're pumping and then they're dumping, so I think in and out is giggity the way to go. You wanted to see XRP setup? This is the really basic one. Where's the other charts? XR Pizzles. This is going to be like the same one. Looking for the same thing still. That wick did kind of jot our plans here. Did mess our plan up a little bit. So what I do like, you're seeing multiple tests of 54, 55 cents. Each time that is tested, that resistance is becoming weaker. So what you want to hold on to as a sign of strength is your lows. You want to see your lows continue to come up. This low, this is on Bitstamp, so I wouldn't be surprised if actually this low didn't exist on, say, Binance. Let's see quick. Correct. It does not. Bitstamp, not so liquid. Not so liquid. Yep, you have higher lows here. That's what you want to see. Flat topping at like 55 cents. Trade can be made of your own accord. Basically, just with that logic. Just using that logic. All right, here's a low, 74. You want to use that low? Do you want to use 46? Sorry, 47, 46. You could use 43 depending on what kind of leverage, if you're going to trade spot or not. Just basically targeting those saying, all right, I'm betting on that resistance that is weakened, breaking. And if that's going to happen, I believe it plays out in a very typical pattern where we see our lows come up. And if those lows are broken, then it's not doing that anymore. So easy peasy, easy cheesy. Today's low actually looked pretty good there. Wouldn't be surprised actually to see 47.5 break. Something like this. I could see that. Kind of invalidating the pattern, scaring people out. What's up, Chaotic Rage and Patrick Powell? What Chads? Be a Chad, subscribe now. Jump in the Discord. Ator. I don't know what Ator is, man. I've never heard of Ator. I don't. Yeah, no, don't have a chart. Let me look at it on CoinGecko. And by the way, guys, I don't just do every chart. I do them when I want. I do them when I want. If you subscribe, I'll look at a chart for you. All right. I don't know what this is, but Bitcoin is not really moving right now. So maybe we'll just open it up, see what we got. It has okay volume. The volume isn't like whatever it is we saw a minute ago. That was total garbage. That was up like 60,000% on $1 million traded volume. Huh. That's something. Interesting. Surprised you haven't heard more people or even like bots yell about this, right? Huh. What is this? It's only traded on Uniswap, MEXC. That's not the best sign. Interesting. Interesting. This is definitely deviating from the rest of the market. $1. I mean, you're at 96 cents now. I wish we could have looked at this, I don't know, a few days ago. $1 is going to be an awesome take profit. It's unfortunate that that's only a few percents away. Psychological level, it's your 1618 extension. If you're looking for a little bit more upside, $1.19, $1.20 for your measured move wouldn't be bad. I'm a little skeptical of this chart simply because it is not really moving with the rest of the market. And I know there's someone out there who's thinking, that's because it's the best thing ever. It's going to change the world. And maybe it is, guys, but I'm going to be honest with you. That's not what moves price. Not now. Maybe in the future. Maybe in the world where crypto is everywhere and it's overtaken fiat. Like maybe then. But right now, no. Utility use just does not reflect in price at the moment. This makes me weary because it's only trending up since May. I don't know when it was listed, but since April of this year. Not a lot of history here, but unlike a lot of charts that look like crap right now, this is in some kind of ascending pattern. So it could continue up, right? But eventually we look for this to break to the downside. We look for this to reverse if it's in this pattern. It has not made, well, I guess it has made some significant retracements. 618 here. 0.5 there. can't really recommend anything on this. I would recommend if I was in a position and I was in good profit, I would probably take some off the table at $1.20, and then I would leave the rest to ride. That's how I would honestly play it. If I was in here from, let's say, 50 cents, I would probably look to sell half my bag between those 2 points, and then I have no risk and I can just let it ride. Because maybe it's going to infinity. Probably not. Thoughts on Pulse Chain? I don't understand, dude. The whole Pulse Chain X, T-shares, Pulse X, just Hex X, like, it almost seems intentionally confusing and hard to follow. That is my honest thought. I've never been a Hex fan. I was a Hex hater for a long time, and I've come to terms that there are more worse things in the space. So I'm probably Hex neutral now. Kind of like XRP. I felt the same way about XRP. Now I'm kind of like XRP neutral. Let's see. XRP neutral. Never thought I'd say that. Younger me is rolling over in his grave. No, I'm just kidding. Pretty tight. 1% spread here. Lows coming up, highs coming down. Still above that 200. Hart's a weird dude. Yeah, that's true. Costco, Julio, thank you for the 2. Dude, 100%. I saw that yesterday, and that was my first thought. The Costco CEO is stepping down to be replaced by their COO, and my first thought was, if they change that price of that goddamn hot dog, I'm gonna riot. I'm gonna riot. You want to see me fired up? You change the price of that hot dog even 1 penny. I have a Costco membership almost solely to get that $1.50 hot dog and soda combo, and then spend the rest of the day burping what tastes like hot dogs. It's a tradition in my parts. I still think Link looks good. Just needs time. Still has that higher low here. Holding $6, it looks good. Here's that pattern that I showed you on LTC, BTC that did not play out. Looking for this. Many tests of your top weakening resistance. You're putting in 2 higher lows now significantly. Just need to see a break. I thought it was at 3. Okay. Well, fam, I love you guys. Apparently I miscalculated the time of my appointment. It's at 2, which is in 6 minutes. Love you all. Make sure you subscribe, sign up with Femex, join the Discord. I love you guys. We'll